Have you ever wondered how emotions, specifically fear and greed, can influence your Forex trading decisions? In the exhilarating world of Forex trading, these two emotions often prove to be formidable adversaries. Their subtle yet powerful influence can sway even the most seasoned traders, nudging them off the path of logical decision-making and into the treacherous terrain of emotional volatility. This is where self-awareness comes into play. The first step in mastering these emotions begins with recognizing their signs. Fear, for instance, may manifest as hesitation, second-guessing, or even an outright avoidance of potential opportunities. You might find yourself pulling back from a promising trade because the fear of loss looms larger than the prospect of gain. On the other side of the coin, we have greed. This emotion can lead to impulsive decisions, driving you to dive headfirst into a trade without proper consideration. Overexposure to risk becomes a real danger when the vision of quick profits overshadows the potential downside. But how do you recognize these emotions? It starts with introspection and self-awareness. Take a step back and assess your decisions. Are you hesitating because of a well-founded analysis, or is it fear holding you back? Are you taking on more risk because the market conditions warrant it, or is it greed driving you forward? By being attuned to these emotional signals, you take the first crucial step towards emotional intelligence in trading. You start to observe your trading behavior from a more objective standpoint, and this awareness allows you to navigate your emotions rather than being swept away by them. Remember, fear and greed are not inherently bad. They are natural human responses to risk and reward. The key is not to eliminate these emotions, but to understand and manage them. Mastering your emotions in Forex trading doesn't mean becoming emotionless. It means becoming emotionally intelligent. By recognizing the signs of fear and greed, you take the first step towards mastering your emotions in Forex trading. So let's continue this journey, shall we? In our next scene, we'll discuss how a well-defined trading plan can act as a shield against emotional turmoil. Stay tuned. A clear trading plan is your shield against the emotional turmoil of fear and greed. The world of Forex trading is often compared to a battlefield, where traders are the warriors and their weapons are their trading plans. These plans are more than just a set of rules or guidelines. They are the strategic maps that lead traders through the tumultuous terrain of the market. Just as a soldier wouldn't go into battle without a shield, a trader should not enter the market without a solid trading plan. This plan should be comprehensive, clear, and well-defined, including crucial components such as entry and exit points, risk tolerance, and profit targets. Think of your entry and exit points as the gates to your battlefield. They define where you step into the fray and where you retreat. By setting these points in advance, you can make decisions based on clear criteria rather than letting fear or greed take the reins. Risk tolerance is another vital element in your trading plan. It's like the thickness of your shield. It determines how much you're willing to risk and how much protection you need. By defining your risk tolerance, you can ensure that you're not exposing yourself to more risk than you can handle. Profit targets are the victories you aim for on the battlefield. These targets should be realistic and achievable based on your analysis and understanding of the market. Setting ambitious yet attainable profit targets can keep greed in check and help maintain focus on your long-term trading goals. A well-structured trading plan acts as a bulwark against the emotional storm that fear and greed can whip up. It provides a sense of structure and order amidst the chaos, reducing the likelihood of impulsive, emotion-driven decisions. It instills discipline, keeping you focused on your plan and less susceptible to the emotional roller coaster of the market. Remember, the market is a battlefield, and your trading plan is your shield. It might get dented and scratched, but as long as you hold it high and stick to it, you can navigate through the market's ups and downs with discipline and focus. With a robust trading plan in place, you can navigate the Forex market with discipline and focus. Fear can freeze our decisions, while greed can make us reluctant to cut losses. The solution? Stop-loss orders. In the Forex trading arena, stop-loss orders act as a tactical defense mechanism against the emotional pitfalls of fear and greed. They serve as a predetermined exit point for a trade, automatically triggering a sell order when the market price of a currency pair reaches a specified level. Think of stop-loss orders as your personal safety net, always there to catch you when the market takes an unexpected plunge. They provide a buffer against significant losses that could result from sudden market downturns or volatile price fluctuations. But how do you determine the right stop-loss level? The answer lies in your risk tolerance. It's crucial to set stop-loss levels that align with your individual comfort zone for potential loss. For instance, if you're comfortable risking only 2% of your trading capital on a single trade, your stop-loss order should reflect that. Now you might be wondering, what if the market rebounds after hitting my stop-loss level? I could miss out on potential profits. This is where greed can creep in, tempting you to move or remove your stop-loss order. Resist this urge. Remember, the purpose of a stop-loss order is not to guarantee profits, but to limit losses. It's better to miss out on potential gains than to expose yourself to potential losses that exceed your risk tolerance. Don't let the fear of loss or the lure of profits cloud your judgment. Instead, use stop-loss orders to instill discipline in your trading approach. By sticking to your predetermined stop-loss levels, you take emotions out of the equation, making your trading decisions based on logic and strategy instead of fear or greed. In essence, stop-loss orders provide a systematic approach to risk management. They're not just about preventing losses. They're about promoting sound decision-making and fostering emotional resilience in the face of market volatility. Strategic use of stop-loss orders can provide a safety net, keeping your emotions in check and your trading decisions sound. Fear of loss and the desire for quick profits often cloud our judgment. Enter the rational risk-reward ratio. In the turbulent world of Forex trading, the risk-reward ratio is a beacon of rationality amidst a sea of emotional turmoil. It's a simple yet powerful tool that helps traders balance potential losses against potential gains, grounding decision-making in logic and analysis rather than fear and greed. Think of the risk-reward ratio as a seesaw. On one side, you have the risk, the amount you're willing to lose on a trade. On the other side, you have the reward, the profit you aim to make. The balance between these two factors is the crux of the risk-reward ratio. But how does this help mitigate emotional decision-making? Well, by setting a rational risk-reward ratio, traders are essentially setting their expectations in stone. They know how much they stand to lose if the trade doesn't go their way, and they also know how much they could gain if it does. This clarity and foresight can help to quell the fear of loss, as well as temper the desire for quick, unrealistic profits. A balanced risk-reward ratio can also help traders stay focused during market fluctuations. When the market swings wildly, it's easy to get swept up in the tide of emotions. Fear can lead to hasty exits, while greed can keep traders in a losing position for too long. But by sticking to a preset risk-reward ratio, traders can navigate these turbulent waters with a steady hand, making decisions based on their initial analysis and strategy rather than their emotions. So what's a good risk-reward ratio? There's no one-size-fits-all answer to this question. It depends on a variety of factors, including your trading style, risk tolerance, and market conditions. However, a common rule of thumb is to aim for a risk-reward ratio of at least 1:2. This means that for every dollar risk, the potential reward should be $2. By embracing a balanced risk-reward profile, you can navigate the Forex market with a level-headed analytical approach. Successful traders know the value of emotional detachment. But how can you achieve it? The key lies in the practice of mindfulness. By incorporating techniques such as deep breathing and meditation into your daily routine, you can cultivate a sense of calm and focus that can be a potent antidote to the emotional turbulence of trading. Taking regular breaks from the screen can help reset your mind, preventing fatigue and ensuring you approach each trade with a fresh perspective. These practices can help you stay grounded and maintain a clear head amid the market's ups and downs. But remember, mindfulness isn't just about keeping calm. It's about cultivating an awareness of your emotions, acknowledging them without judgment, and then making the conscious decision not to let them dictate your trading decisions. This process of emotional detachment doesn't happen overnight. It requires patience, practice, and perseverance. Practicing mindfulness and cultivating emotional resilience can help you trade with a calm and centered mindset. Fear thrives in the unknown, and greed in the allure of quick profits. The antidote? Continuous education. In the dynamic world of Forex trading, knowledge truly is power. It's the beacon that guides traders through the murky waters of market fluctuations and the shield that protects them from the emotional turmoil of fear and greed. Continuous education empowers traders by providing them with the tools they need to make informed decisions. It equips them with a deep understanding of market trends, analytical techniques, and risk management strategies. This knowledge helps to demystify the market, reducing the fear associated with the unknown. Meanwhile, an educated trader is less likely to fall prey to the siren song of quick profits. They understand that successful trading is a marathon, not a sprint, and that patience and discipline often reap greater rewards than impulsive decisions driven by greed. So empower yourself through learning. Subscribe to the Guardian Forex TV for more insights and stay ahead in the Forex trading game.